Isn't it funny how everybody tries to predict crypto, how everybody tries to figure out where Bitcoin will be, but in the end, all we're doing is guessing. We don't know if our models will hold in the future. We have seen models break very often in the past, but I do believe there are some differences. There are some approaches that make more sense than others. We're going to look at those approaches, but let's first look at historical failures. If you've been around in crypto for a while, you might remember this story over here. If you hold Bitcoin for just 4 years, so over the course of one halving cycle, you should always be in profit. And the idea how this was manifested is with the 200-week moving average. So that's roughly 4 years. Bitcoin had never been below that moving average for an extended period of time. Now, if you bet on that in the middle of 2022, then you might have gotten a rude awakening. The model suddenly broke. Apparently, Bitcoin could never be below 24K, but then we fell all the way down to 16K. Now that's an additional drop of more than 30%. And then the big question is, what do you do during times like this? Does it make sense to still be in Bitcoin? Are we still trusting the model that worked so well in the past, where we suddenly go above that moving average again? Of course, we all know what happened. In the end, we recovered, but it shows us that an approach that worked in the past to time the bottom nicely doesn't necessarily have to work in the future. If we take, for example, leverage, whenever we were close to the moving average, you might have gotten completely wiped out at that time. Or have a look at this chart. This is a logarithmic regression on Bitcoin. It's the Bitcoin rainbow chart. It looks a bit, let's say, entertaining. And it gave us at the time, so that was in 2020, an upper range of Bitcoin's price at around 116, 117K. It appeared to be a good idea to always buy when we are in the blue area and to sell when we get close to the red area. So at this point in time, when Bitcoin was at 40K, it would have been only logical to continue waiting until we double, potentially triple again. But that's a problem with approaches like this, right? They can give us some kind of a range, but they don't give us perfect bottoms and top. Those models can break all the time. And so the prior chart went until here. And unfortunately, we did not hit the red area anymore. If we did not take any profit at 50 or 60K and you waited all the way to get to the red area, what tended to happen in the past, then you did not lock in any profit and instead you went down all the way to 16K. So a drop from more than 60K to 16K, a 70% decline. If we try to time the market, if we want to ride the cycles to a degree, we want to sell high and buy low, then of course a 70% decline is not necessarily something we want. Now, what does this mean? Does this mean we have to throw away all of our models? Does it mean they're completely useless? I don't think so. They still have some use case. However, we have to use them in a smart way. I also think that any mathematical model that only looks at price data doesn't incorporate enough data. I do think, especially in crypto, we've got all of this additional data and we should use it. Now, the issue is, how do we price something like Bitcoin? What's the fair value? Is it 100K? Is it 1 million? Is it only 10K? With something as intangible as Bitcoin, it's not that straightforward. With stocks, we can use the future cash flows, right? We can estimate what will this company make in the future. Or with property, we can do the same thing, right? We can estimate what will be the future rent incomes. We can just add up all of those future incomes. We can put them to the present value of today. And then we've got the value of that asset. Now, the issue is that gold and Bitcoin, etc., does not produce any future cash flows. So we have to value this differently. I believe what mainly drives the crypto markets is psychology. So if a lot of people are currently in profit, then it's very likely that some people take that profit, right? They might sell the Bitcoin and then move this into other asset classes or potentially just use the money for consumption. If a lot of people are currently in losses, then most people just hang on onto their Bitcoin, right? If you believe that Bitcoin long-term will outperform fiat, the long-term upwards trend is intact, and if you're currently in losses, you just keep on holding. You're not selling that like. And so that is what's shown in this graph, the net unrealized profit and loss. So again, we've got the Bitcoin price in black, And the net unrealized profit and loss is in blue. When the blue line is in the green area, it means that the market as a whole is currently in losses. So that the recent purchases that had been made of Bitcoin were below the average purchase price across all of Bitcoin's history. If the average Bitcoin holder is in losses, those losses are unlikely getting realized and a price bottom can form. It makes a lot of sense to buy whenever the blue line is in this green area. Conversely, when most people are in profit, so the average net unrealized profit above 80%, then it does make sense to take that profit, because we want to sell when prices are high, we want to buy when prices are low, and we simply just oscillate across losses and profit, losses and profit. We can also look at this in terms of the anchor point in the market. So let's say you've got your Bitcoin, you bought your Bitcoin, you've got it in your portfolio, and you look at the current price. You will always refer the current price to the price that you bought Bitcoin at. So you always have your anchor point. If you're currently in profit, if the number is green enough, you might sell sometimes. The current number is in red and you believe in the asset long term, you just keep on holding. So your purchase price matters to you. Now that's on an individual micro scale. We can also look at this for the entire market. What is the reference price on average of the entire market? And that reference price is called the realized price in Bitcoin. So when the current price is above the realized price, people are in net unrealized profit. When the current price is below the realized price, so below this orange line, that's when people tend to be in net unrealized losses. The reason why this line is so useful is because it gives us potential bear market scenarios as well. Nobody wants to know about the bear market when prices are going up, and we are again above 100K. But it's good to keep this in mind. If the current realized price is 46K, then we have to manage what happens in this edge case. There's two ways to do this. We could either use a stop loss, so we are selling once the current momentum turns around. There's all kinds of ways to do this, right? Let's say 10% below the all-time high, we sell, or whatever your risk tolerance is. Or the second way is to just have less of an allocation to Bitcoin. So to have the Bitcoin allocation just low enough that even if the price goes down by 50%, it doesn't bother us, because maybe only 10% of our net worth is in Bitcoin. If those 10% move to 5%, it doesn't really make that much of a difference. So there's two ways to do this. We either ride the wave to the downside and we are okay with the temporary loss, or we have more exposure and we just cut losses very early. But we always have to be realistic what potentially could happen in the worst case. And we have to be mentally prepared. What are we doing in those cases? Because you do not want to have most of your money in crypto and it's years and years of your income, and you don't cut your losses in case things turn around, right? You don't want to suddenly go from 10 years of income saved up to only 5 or 4 years of income saved up. You can't save your way out of this. You're just then hoping for the price to recover, which it likely will, but again, is psychologically very nerve-wracking to be heavily invested and go all that way down by 70% and more. Now you can get fancier and fancier with those approaches, but in general, the gist is the same. We can have a look at the market value to realized value Z-score, for example. So this looks now at the net unrealized profit relative to the volatility, as in how volatile is the price? Is it going up and down massively, or is the market rather calm? If it's going up and down a lot, then we are okay with being more in profit. If the market is rather calm, we should take profit faster. And so again, it's a nice oscillator. It tells us when the market is extremely heated, which we haven't been since February 2021. Isn't that fascinating? So we had this nice move from 3.5K all the way to above 60K. But since we returned back to 16K, above 100K again, we haven't yet seen that much unrealized profit relative to the volatility. Here's another thing I like to look at. Again, we only have this kind of data for the blockchain. We can't see this for traditional finance, but I think it's very useful. It's better than just looking at price data. This is the value days destroyed multiple, or VDD. It measures what are the whales in Bitcoin doing. The whales that tend to never move their Bitcoin. When they suddenly move their Bitcoin, we might be temporarily at least heated. Now, this is not a perfect indicator, as in we sometimes continue to go up a bit longer. But it does tell us when at least temporarily there might be a retracement. We can also have a look at all of the short-term Bitcoin that had been moved in the last 3 months. When this is high, then there's a lot of short-term speculation and we might be at the end of a bull run. When this is low, the market is rather cool. Currently, it tends to be rather low. The market was more heated when Bitcoin was at 72K and when Bitcoin hit the 100K for the first time. But check this out. This is the realized HODL ratio. So this looks at how much trading activity is there among the short-term holders versus long-term holders. When there's a lot of short-term holder activity, then the market is hot. When there's only long-term holder trading, the market is cool. And of course, we want to buy when the market is cool, when prices are low. Currently, we are not incredibly hot, but we are also not very cold either. Now, fundamentally, the problem is that returns are very much concentrated in a few assets. Most assets tend to go down, and there are a few altcoins that make the multiple X returns. And the problem is those assets change over time. What worked well yesterday might not work tomorrow. And so it's always a game against the odds. And so we can't really deploy a lot of capital in those trades. If the likelihood of losing is very high, it means we can't deploy too much in the position. It also means we can't necessarily diversify, because if we now own 10 or 20 tokens, most of those tokens are losing. And if then the few outliers make up for all the losses is a completely different question. It's very unclear. Now, there is a way to make money a bit more consistently, and that's actually trading the larger tokens. The issue with the larger tokens, though, is that they move very much in tandem with the overall market. As in, when Bitcoin goes up, then Solana tends to go up as well, Ethereum tends to go up as well. But there are movements within crypto where sometimes a particular asset class is more preferred than another one. And we can play on that relative valuation. We can play on attention moving from A to B within crypto without having to try to find the few winners. For example, have a look at this. This is the Solana dominance. So how much of all of crypto is currently in SOL? And there seems to be somewhat of an invisible ceiling between 3 to 4%. This is where Solana historically had been very expensive. Or have a look at this. This is the Ethereum dominance. It tends to be very cheap when only 7% of all of cryptocurrency's market cap is in ETH. It tends to be expensive when it's around 20 or 21%. And so we can benefit from this independent of where the US dollar valuations go. So if Bitcoin is going up or down does not interest us. The only thing that interests us is whether or not Ethereum will perform better than Solana or Solana will perform better than Ethereum, just relatively speaking. So I saw that set up when Ethereum was extremely cheap in the middle of April. We got very close to the historical low that was formed in September of 2019. And so have a look at this. This is Solana relative to Ethereum. And when ETH hit that low point, I shorted Solana relative to ETH. So I was not interested at all in the Solana US dollar price or in the Ethereum US dollar price. I was only interested in the relative valuation. I saw we are high on the trading range and I bet on that range coming down. So here's that post. It's from April 13th. I'm opening a relative valuation short of SOL to Ethereum using Venus Finance. More information will be provided in a few hours in today's premium update video. So I publish premium updates every 3 to 4 days. And then on May 20th, I closed the position. And of course, other members made money with this as well. But I want to share something here. This is when the position was opened. Here is when the position was closed. And I want you to look at the Solana value. Again, we bet on Solana doing worse than Ethereum. Solana itself actually went up during the time. It appreciated by 25%, but Ethereum appreciated more than that. It went up by more than 50%. And so we completely canceled out the macro. We are not interested at all whether or not everything is going up or down on a given day. We made money just on the relative valuation. So within those few weeks, we went from 43K to almost 60K. Yes, I know these kind of strategies might seem a bit complex, and why don't we just buy an altcoin and make it 10x? But again, it's all about risk-adjusted returns. If we want to bet significant capital, tens of thousands of dollars, or let's say relative to your net worth, high percentages. We don't just want to play with play money, but we actually want to make real gains. We need to use strategies that don't have an 80 or 90% chance of failure. I see people making these mistakes all the time. I even see people making mistakes with their risk off position. So let's say they don't want to be exposed to crypto, they just want to be in stable coins, that those stable coins just stay laying in the wallet. But there are opportunities to make very nice constant returns even with stable coins. So this is 16% APR. This can be achieved on Hyperliquid without a single trade. This is all just automated arbitrage by the market maker. But of course, I've also got my risk on part of the portfolio. And here's something other people don't show. Most people just show individual trades and say, hey, this is how we always make money. Very few people are actually willing to share their overall portfolio performance. Now, I started trading on Hyperliquid on April 22nd, and here is my P&L over time. And since I'm sharing all of my trades, the members can just copy me. And this is actually very nice feedback. The same kind of portfolio development chart. This chart tells a story, first trying it without any support, and then afterwards, where this green arrow is shown, exclusively following Gerhard's trade and slowly digging out of the hole. If you've got the right risk management in place, there's actually a lot of money to be made in this market still. But actually, I don't want that everybody is just copy trading me. The community is about elevating our skills. It's about learning as much as possible, helping each other, finding market opportunities, and then of course capitalizing on those opportunities. So I've actually made more than 100 tutorial videos just on various topics within crypto, risk management, portfolio valuation, blockchain analysis. Feel free to binge watch this. It's actually nice to get those DMs. Hey Gerhard, I just wanted to thanks a lot for everything you've done. Since I've only been listening to you, I've been consistently profitable now. I just entered your, I've blacked this out, XYZ position as well. Or here, this is also another nice message. I'm not going to read through all of this. Feel free to stop the video. But yeah, if you want to join us, if you want to copy trade me, if you want to learn more about crypto, feel free to check it out. It's currently $125 per month. The price has actually been lowered because now the attention on crypto is much lower than it used to be a few months back. Once the masses come back in again, then the price will be back to $165. So if you're signing up today, you will never pay a higher price. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.